Let me guess. You're Canadian. You're trying to save money, and somewhere between rent, groceries, and the subscription you forgot to cancel, it feels like the system is stacked against you. Now imagine there's an account, one that's been available since April 2023, that gives you a tax refund every time you put money in, grows your money without the government touching it, and lets you withdraw every single dollar. Tax-free when you're ready to buy your first home. 3 tax advantages, 1 account, and as of today, most Canadians still have an open one. What if I told you the account exists, and the only thing standing between you and thousands in tax savings is knowing how to use it? Hi, I'm your guide for today, and we're exploring the First Home Savings Account, the FHSA, and why it might be the single most overlooked financial tool in Canada right now. Here's the advice most Canadians have heard. Save for a down payment in a TFSA, your money grows tax-free. Contribute to your RRSP, you get a tax deduction this year. Pick one because you can't have both. That advice was true. Until 2023, the FHSA takes the best feature of the TFSA, tax-free growth and tax-free withdrawals, and combines it with the best feature of the RRSP, a tax deduction on every dollar you contribute. It's not one or the other, it's both in one account. Now here's the part that should make you pause. Fewer than 1 million FHSAs had been opened in Canada by the end of 2024. That's out of roughly 15 million eligible Canadians. The math suggests about 14 million people are leaving tax refunds on the table, not because they can't afford to save, because nobody walked them through how the account actually works. Let me break this down simply. The FHSA gives you 3 tax advantages, and they happen at 3 different moments. Number 1, money goes in and your taxable income goes down. Every dollar you contribute reduces the income you're taxed on this year. If you put in $8,000 and you earn $60,000, the government taxes you on $52,000 instead. You just bought yourself a tax refund. Number 2, while your money sits in the account, nothing that happens inside is taxed. No tax on interest. No tax on dividends. No tax when you sell one investment to buy another. The account is a sealed bubble. The CRA can't see inside. Number 3, and this is the one that separates the FHSA from an RRSP, when you withdraw the money to buy your first home, you pay 0 tax. Not deferred tax that comes back later, 0. The RRSP gives you a tax deduction now, but taxes you when you withdraw. The TFSA gives you tax-free withdrawals, but no upfront deduction. The FHSA gives you both, deduction now, tax-free later. That combination doesn't exist anywhere else in the Canadian tax system. Let me show you what this looks like in actual dollars. Say you earn $60,000 a year. You contribute the full $8,000 to your FHSA. At a marginal tax rate of roughly 30%, depending on your province, that $8,000 contribution generates about a $2,400 tax refund. You didn't lose $8,000. You moved it into your own future, and the government handed you back $2,400 for doing it. Now do that for 5 years. $8,000 times 5 is $40,000 in contributions, but you also get roughly $12,000 in tax refunds over those 5 years. If you reinvest those refunds back into the FHSA, which you should, and we'll talk about that, you're looking at over $50,000 toward a down payment without earning a single extra dollar from your job. That's before any investment growth. And here's what most people miss. You can contribute up to $8,000 per year, with a lifetime cap of $40,000. If you don't use your full room this year, you can carry forward up to $8,000 of unused room to the next year, 1 year only. So don't wait until December. Open the account now. Now let's address the question that stops people from opening this account. What if you don't buy a home? The FHSA doesn't punish you. After 15 years, if you haven't purchased a qualifying home, your FHSA balance can roll directly into your RRSP. No tax hit, no penalty, no wasted effort, and critically, this transfer does not use up your existing RRSP contribution room, it's bonus space. So the worst case scenario is you saved money, you got tax refunds every year, your investments grew, and if you never buy a home, all of it moves into your retirement savings. Tax-free, with extra RRSP room you wouldn't have had otherwise. That's not a worst case. That's a second best case. And the best case is you buy your first home with a down payment that was built by the tax system itself. So where do you actually open this account? There's no single right answer. And anyone who tells you there is hasn't asked about your situation. Here's what you need to know about the landscape. If you want a self-directed investing FHSA, meaning you choose your own stocks, ETFs, or GICs. Questrade, Wealthsimple, and Qtrade all offer FHSA accounts with no annual fees. Questrade gives you commission-free ETF purchases, which matters if you're adding money regularly. Wealthsimple offers fractional shares, so you can invest exact dollar amounts. Qtrade has a strong research platform and currently offers a cashback bonus on new FHSA accounts. If you prefer to keep everything with your existing bank, all of the Big Five, TD, Scotiabank, RBC, BMO, and CIBC offer FHSA accounts. The trade-off is typically higher fees on the self-directed side, but you get in-branch support and everything in one place. TD's FHSA integrates with their Easy Trade platform, and Scotiabank's connects to iTrade. If your priority right now is simply parking cash at a competitive rate while you figure out your strategy, EQ Bank offers an FHSA savings account with their standard high interest rate and no fees. No investing component, just interest. It's a clean, simple starting point. Now here's where I want to be straight with you. I don't know which of these is right for you. I don't know your income, your timeline, your risk tolerance, or whether you're buying in 2 years or 10. And I wouldn't recommend a financial institution to someone whose full picture I haven't seen. So here's what I'd suggest instead. Before you open an FHSA with any institution, before you pick a platform because someone on YouTube told you to, let's actually look at your numbers. Book a session with me. The link is in the description. We'll go through your income, your savings capacity, your home buying timeline, and which institution actually fits your situation. I don't push one company. I help you understand the landscape so you can make the right call for you. Most people walk out of these sessions knowing exactly where to open their FHSA and exactly how much to contribute each month. Some realize the FHSA isn't their priority right now, and we build a different plan instead. Either way, you leave with clarity. The session link is below. If the calendar's full this week, check back. I open new slots regularly. Once your account is open, the real power is in making it automatic. Here's the system in 2 steps. Step 1, set up an automatic transfer. Same day your paycheck lands, $25, $50, $200. The amount matters less than the consistency. When the money moves before you see it in your checking account, it never feels like a choice you have to keep making, it just happens. Step 2, when your tax refund arrives, and it will because FHSA contributions are reported and you get that deduction, route it straight back into the FHSA. That $2,400 refund isn't bonus spending money, it's prepaid savings the government is returning to you. Put it back in, and next year it generates its own refund. This is compounding through the tax code. Your refunds generating more refunds. Over 5 years, reinvesting your refunds adds thousands you didn't have to earn. Purpose protects the money. An FHSA is visibly separate. It's not mixed into your checking account where it feels available for anything. It's earmarked for a home or for your retirement. Either way, it's not getting spent on takeout. Here's what the FHSA actually buys you that a regular savings account never can. It buys momentum. Every contribution is matched by a tax refund you didn't work for. It buys clarity. The money has a name and a purpose, and it buys you a door that stays open. Whether you buy a home in 5 years or never, the account keeps working for you. You don't need to have the full $8,000. You don't need to know which investments to pick. You just need to open the account and book the session so we can build the strategy that fits your life. If you found this helpful, don't forget to like, share, and subscribe. The booking link is in the description. And if you want to see how this fits into a full financial readiness plan, watch this next. It's our breakdown of how long your savings actually last after a layoff in Canada. Until next time, stay proactive and stay prepared.